Yeah, okay. Good afternoon, everyone. So this talk is about risk management. And risk management has many meanings and interpretations all over blockchain and crypto. Here I will focus mostly about economic risk management of lending markets. However, the vision hopefully will eventually scale also for more general risk management. So in lending markets and stablecoin, risk management is mostly about giving some credit or loan to other people and hope that eventually they will actually pay it back and won't wreck you. And in traditional market, you have rating agencies, but already in traditional market, they are notoriously political. Some allege that they, gave rise to the 2008 financial crisis because eventually, they are rating loans, rating countries. There are a lot of political issues, who is friend of whom, the power structure between American economy, other economies, etc. So of course, then came crypto, a big part of it out of the 2008 financial crisis. But yeah, as you know, risk management in crypto is even more notorious these days. At the 2022 bear market, we saw big entities getting wrecked, becoming insolvent. Funds, like if you take 3 arrows, FTX, it was all about humans coming and, making some decision to pause liquidations because, they believed that eventually they will pay the money back. Maybe they didn't have any choice. But eventually all of that end up in a huge insolvency event. And you can argue, okay, so crypto, it's kind of the Wild West, but, in TradeFi, we have regulated markets. Maybe things are better. So this is just an example, from the last year. We have the London Metal Exchange, fully regulated, fully boomers exchange. So yeah, they also decided, to pause the trade. As a result, some of the big whales there didn't get liquidated, and we can only speculate why they decided to take this step. Okay, so the traditional finance risk management, is also in centralized crypto, but of course, this would have never happened in DeFi, right? Because DeFi is fully transparent. We all know what is going on. So yeah, it's fully transparent, but still, in most of the protocols right now, it is DAOs who are taking decisions. DAOs are allegedly more transparent, but still very much political, taking a lot of human factors into account. And this is a recent event around 2 months ago or so. USDC got depegged. It was a very crazy weekend all over DeFi market. And then Gantland, who are managing the risk for Aave, came up with a proposal, which is, by the way, completely reasonable proposal, but like a proposal that eventually has a political decision-making, nevertheless. So to pause all the liquidation in a certain market. And yeah, it could have, risk other collaterals, could have result in insolvency, but like from their point of view, this is the right decision to take, which, by the way, might as very well be the right decision. We know all these things only in retrospect. But of course, you can argue Gantland is non-political, but of course the DAO decision eventually that have to accept this decision is very political, has multiple interests. Maybe they have their own account there. Maybe the assets belong to some hedge fund who are big supporters of the protocol. Maybe the token itself, is somehow connected to the protocol, etc., etc. And these are the kind of things that, as a DeFi user, you don't really want to happen. You want to have some certainty in execution, determinism in, what will and will not happen. And these kind of things kind of give rise to, political and backdoor channels, which eventually are unfair and make everything less predictable. So some background about myself. So I'm the founder of B.Protocol, and we try to mitigate risk. But I'm also part of the human factor, and I'm a contributor to the risk DAO. In the risk DAO, we also do risk analysis as a service. So right now, we are very much also part of the problem, not of the solution. But in our B.Protocol hat, we try to automate all of it and eventually also replace us by some kind of Uniswap formula. And this Uniswap formula also very much connected to what I did previously. Back in Kyber Network, we were doing a lot of on-chain market making done by heavy backend algorithms, only to be eventually get replaced by formulas, which were on some level much less efficient, much less profitable market making algorithms, but nevertheless had much better product market fit to DeFi and the DeFi ethos. So the goal that we aim to have is to eventually set all the risk parameters to keep the platform solvent and investors as a whole. Coining it like to details, so we need to take care of loan to value ratios, liquidation thresholds, and many other lending market parameters, which are right now need to be heavily maintained by some DAO organization and eventually by humans. And this is like a typical risk management process in DeFi. So someone make a forum post, or even before the forum post, you have some risk management entity. People don't really understand what the risk management entity does, but nevertheless, they do their best to make proposal to the forum. Then eventually, if someone at the forum cares enough, they will try to promote it, moving to an on-chain vote, and eventually it will get executed. So this process is not only very human intensive, but also typically take weeks to execute. So it's both non-transparent and also cannot really react quickly to different market conditions. So the question is whether we as a developers can do something to save it, and like following the DeFi ethos is to try to replace all these human decisions with some kind of deterministic algorithm. And almost by definition, by doing so, we will get a result that is less precise, potentially might even be riskier. But at the end of the day, not doing that might be even riskier, not really DeFi. So this is kind of what we hope to achieve. So if you remember all the previous slides with the very complex chart, so right now we are working on replacing it with one relatively simple formula, which will take kind of objective parameters into account, but then also could give rise or give some input. So it could give some space to some either human input or maybe some DAO input in the form of confidence level that could embed some special knowledge, but would still make everything more transparent. And this is something that could be maintained, like in ranges of months rather than days or hours. And the missing piece for that, so this was an example to one formula that we plan to launch next week. But of course, it's ongoing research, to find and make these formulas more standard, also to make them open source, because right now all the risk vendors, they are kind of proprietary simulation systems because eventually they make money out of it. So we have to make a formula with an open source smart contract in order for it to be transparent. And another issue is that the relevant data is not even on-chain. So right now, you have Oracle services that will tell you what the price of an asset is, but not the inputs we need for a formula, which are in the form of standard deviation, DEX liquidity, and in the future maybe other parameters. So this is where B.Protocol and now also the risk DAO kind of collaborate, where the goal of B.Protocol is to have some mechanism and consensus algorithm to put the relevant data on-chain, and then researchers, including risk DAO, will develop the open source layer on top of it that will facilitate risk analysis. So this is an example. We are still not live, hoping to go live on testnet in a few weeks. So automatically setting the LTV ratio of lending markets. This is something pretty desirable, both because it is notoriously for being non-transparent process, but also because it's very cumbersome process that requires days and weeks of discussions and voting, where most of the time the outcome is pretty trivial. Further down the line, we can envision a situation where this is done completely automatic, without any human intervention, just by getting liquidity data feed and volatility data feed that B.Protocol will provide. You will have a DAO that will have to, so now the lending market DAO will not have to approve each parameter, but only a template or a formula of the LTV. And this will be updated in a near real-time manner or even real-time manner. So it could react very quickly to market conditions, but also be transparent and as objective as possible. Also further down the line, it could also decide on more maybe binary decisions. For example, whether you want to list or you don't want to list certain assets. It will prevent DAOs from listing kind of stupid and shady assets, which is, by the way, like one of the things that actually block and prevent a lot of innovation in this space is that, unlike setting up or forking your own Uniswap clone, when forking Compound or Aave, eventually the core trust is about the risk management, about not doing stupid things with asset listing and risk parameters, and all these things will give you both transparency, but also will make these things more of a commodity and more of a standard operations. So this will allow for more innovation, because now it will be much easier for new projects to enter this market. So with the risk oracle and the formulas around it, we can kind of bring lending markets really back to DeFi ethos, because right now lending markets are, and also stable coins, so they are very much resemble the on-chain finance ethos, but not really DeFi, because eventually humans there decide a lot of the things. So right now everything is very politicized, manual, a lot of governance and opaque, and with the oracle things will become more neutral, even on potential expense of efficiency, but it will be neutral, will be automated, less governance hassle, self-executed as smart contract and blockchain should be. And of course, transparent and decentralized. So this is kind of joint work, and the two teams are also very much overlapped between the B.Protocol and the Risk DAO, and you can contact us on Telegram or Twitter. Also go to our website, B.Protocol or riskdao.org. Yeah, thanks.